Good evening. This is Ken Long from Tortoise Capital. I want to do some quick case studies here on some swing frames from the daily report from July 9th, 2014. All right, so we're taking a look at the page 2 of the daily report that summarizes the market conditions and a lot of our signals. We've got a bullish quiet market that's overbought long-term, has pulled back into the neutral on the short-term 10-day. The risk index tells us, since it's north of zero, that it's still favorable to hold riskier assets. We can see that the market has been very quiet in terms of volatility. It's down in the quiet range and has been there for about 20 days. ADX is strongly indicating a bullish trend. And what we have right now is IWM, the Russell Small Cap, is firing on the index channeling system. So we'll take a look at that one. In the summary of our different swing setups here, we'll see that DBC, the blended commodity ETF from Deutsche Bank, is a signal on channeling, overreaction, 5 days down, and tests out favorably on the auto framer. So we're going to look at DBC. We'll take a look at DD, which is DuPont, which is a channeling signal. It's also the number one 10-day max pain, meaning it's lost more than anything else in the Dow on a percentage basis in the last from its 10-day high. We're going to take a look at one of our favorites, Coca-Cola, on a 551W signal. There are more things we can look at, but just want to take a quick look at those four. So the first one we'll look at is IWM. And so generally upward trending river. The 270 regression line in pink is flat. The dragon is on the far side of the river here. The river is a stark shaded blue area, 30-period Bollinger Band plus or minus 1. The lighter blue shaded area is the floodplain. That's the Bollinger Band 30 plus or minus 2. Price tested the top of that. It has pulled back now to the Bollinger Band mean, a perfectly ordinary retracement during a bullish trend in a market that's rolling upwards after a long period of time when IWM was lagging and going sideways. The last 30 days or so it's been up, and now it's had one and now two pullbacks. This time it came back to the Bollinger Band mean and signaled a channeling, meaning that it's oversold on a 10-day basis. So we can buy the opening tomorrow mechanically if we follow the mechanical rules, in which case we would buy the open and we'd use a 5% stop, which in IWM is this lower red line, about $5, maybe $5.50. And then if we wanted to frame this trade with a tighter stop, we might wait for price to take out yesterday's high at about 117.20, and then we'd use a stop here at the swing low at 115.60. So we're talking about $1.50 of risk. If we follow the mechanical rules, we would sell when it crosses back over minus 30 on the Williams percent R. In other words, it was no longer oversold. That would get us probably a price somewhere around 120. If we wanted to play for more, we could just follow that with a 2-day trailing low. If we're engineering the trade here and we're using this tighter stop, now a retest of the far side of the floodplain would be an excellent trade. We'd probably get more than 1R if it just comes back and tests the 270 regression line. So we have a number of different strategies here that we can use to frame this trade with a very reliable channeling system signal, which offers generally about a 0.7 to a 0.8 reliability in a bull market that 3 to 5 days from now this thing will have retraced back towards the fair value up here around the 30 regression line, around 120. So a number of different ways we can play IWM. Next one is DuPont. This frame is for at various signals. It was a channeling, like we just saw in IWM. A max pain. It's a max pain range compression number 1 in the Dow 30, meaning it's the most favorable in terms of how much it's lost divided by the compression of yesterday's range. So like a coiled spring, it fires as the number 1 candidate on max pain range compression. And on the auto framer, it tests out at 4.4 to 1 based on range risk and then a retest of the 10-day high. So if we want to frame this trade now, knowing that there's a lot of reasons to be interested in this actually is a multi-directional trade frame. And so if we use yesterday's range as the yellow zone, and maybe this last 5 or 6 days as the yellow zone in here, in which price has not voted one way or the other, we would set up a trade to buy if it takes out yesterday's high plus a nickel at about, looks like about 65.65, but not later than price re-entering the river if you wanted to be a little more conservative. And then that would be a Z trade in which it had left the floodplain, and then we buy not later than re-entering the rivers. That would give us an entry about 66.25. If we take the mechanical entry, our first profit target or price target is the re-entry of the river at 66.25, then the Bollinger Band mean at 67.80-ish, far side of the river at 69.25, the 270 regression line as long-term fair value at about 69.75, and then if it overshoots, then a move as far as 70.75. So you can see there's a price ladder of reasonable targets on the way up. We have a significant distance between the 270 regression line here in the pink and the 10-period regression line in the blue. So we have a regression line fractal framework kind of a trade going on here with a significant retracement possible here in DuPont. I should also say that if we get failure below 65, then this is an auto short because then whatever it caused it to have gapped down and then failed to follow through points the way downward, and so that would be an auto short. So that's why we'd frame this as a bidirectional trade. This is DBC, that blended commodity, and this fired on a bunch of different signals, channeling, overreaction, and so there's a lot of good reasons to like this. I just want to highlight the regression line fractal format idea here of the move from the 270 and the RL10 came together here, and then the next move was up from roughly 25.85 to as high as 27, so $1.20. That's a 5% move, and very orderly since this is a blended commodity based. And then when it couldn't get any further, and we get this Z trade, you see how quickly the dragon rolls over too. And again, we're buying, or actually selling, not later than re-entering the river, but you could also play it on as it leaves the dragon or 2-day lows, takes out this gap, whatever you want. But even on an RLFF basis, going from, you can see the extreme divergence from the RL10 back to the 270, and that would be the price target on a short if we see failure, and that's actually what happened here. So now what we have is, after the failure has occurred, we've got price has fallen out of the river. It may find support here where it found support the last time. That would be the hypothesis. If it fails there, then this is an auto short below 25.85. But if it finds support here where it found support before, you could make an entry here at 26.08, which is not only above yesterday's high, but it's also price re-entering the river. And then our price targets would be at the Bollinger Band mean at the far side of the river and then the far side of the floodplain. And then that's a move that it's already made twice in the last 30 days. So we know that it's capable of making that kind of a move. If it fails from here, then we would just use a little bit of geometry and say the excursion from the 270 to the extreme on the 10, we would project that to the downside and we'd look for $1 on the downside. So you have a very favorable reward to risk ratio trade there. This is Coca-Cola. This was after a sideways quiet channel period here in the center, and it left the river, so the sideways quiet channel pattern number 3 in the RLCO framework takes off, gets and rides the edge of the floodplain all the way up until it can't go anymore. Get 5 days of pullback, and then 1 day on the upside, and this is why it's a classic kind of a 551W. You have a bullish trend here. You can see that the 270 regression line is tilted up and price is still pulled away, so the Coke has been very favorable. So price closed higher than it did 25 days ago or 5 weeks. So that's why that's the first 5. And now it's down from where it was 5 days ago. That's the 5-day pullback. And then the 1 is it had a 1-day white candle. And then the W that on a retest of the 10-day high using today's range, we still have a 2 to 1 frame available. So you get this 551W. And so we could look at this also as an RLFF framework, that the distance from the 10-period regression line in the blue down to the 270 regression line is 5 ATRs. So if we actually saw failure here below 4180, we could frame that trade and enter short with targets of Bollinger Band mean, far side of the river, and then return to the 270 regression line. Or if we play this to the upside as a continuation pattern, this is something that has been riding the 2-period Bollinger Band, pulled back, and then if it were to find support here at the edge of the river and then takes off again, we could go ahead and enter at 4220. Our first target would be about 4270-ish, and you could even think about adding a second position if it cleared the previous swing high, and then it's free and clear with no resistance overhead. So we like Coca-Cola here as a bi-directional trade in a critical state with a 551W in a bull quiet market, and an RLFF framework trade to the downside as well. And so those are 4 trade frames. There's Coca-Cola, blended commodities, DuPont, and then IWM from our daily report for July 9th, 2014. So thanks for your kind attention. Keep your risk measured and your powder dry.